Hello, Mr. Client. Thank you so much for letting me into your house. My name is Paul Chang. Here's my business card. Been with the company for over 7 years now, and the only reason that I get into your house is we send you a copy exactly a letter just like this one, and you actually selected that letter and you send this back to us. I just want to make sure that the information is correct. Your date of birth is 11/12/51 and your spouse's is 11/1/56, right? The mortgage is for $390,000, which is a 30-year mortgage. So this is information that you gave us. Whatever I want to provide today, Mr. Client, is free. There's no cost or obligation for any of this information, okay? Now, Hartford actually pays me just to show you how the program works, okay? And there are 4 benefits in this letter. The first one, in case of a death, God forbid you die or your spouse dies, we pay off your mortgage free and clear for your family. That's for the $390,000 mortgage. Now we pay upon any death, accidental, terminal, cancer, whatever the death may be except suicide. That's the only one we don't pay. Okay. Now the second benefit is optional, depending upon your occupation. If you or if your wife becomes disabled, we pay your mortgage on a monthly basis until you go back to work. This is based on your own occupation. So if you cannot go back to whatever you were doing at the time you got disabled, we start paying your mortgage. Okay? Now the third benefit is the best benefit. Let's say nobody dies and you pay off your mortgage in the next 30 years or you pay it off sooner. The Hartford will give you back all of the money that you paid into the policy. So if you happen to die, God forbid, the mortgage is paid, but if you live, you get paid because you get all of your money back. Okay? And the last benefit is that actually we show you a way you can pay your mortgage off sooner. Now you and I have a 30-year mortgage. In the next 30 years, we're going to end up paying almost 3 times whatever we borrow because of compound interest. And you know this. Now with this program, since you accumulate cash in the policy, you can use that cash at any time to pay that mortgage off before the 30 years. If you do that, you're going to save a lot of money in interest in the back end of your loan. Okay? So those are the 4 benefits that are inside the letter. Okay? Now let me ask you at this time, out of these 4 benefits, which one is the most important for you at this time? Benefit number 1, okay, in case of a death? Good. Now, most of the clients actually pick that because that's the most important one. If something happens to you, your family will be protected, okay? Now, let me just talk to you about a little bit about the Hartford. We're not a new company. We have been in business since 1810. This is our logo. Our company is going to be a 200-year-old company pretty soon. Now, when Napoleon was trying to rule the world, that's when we wrote our first policy, okay? Now, Abraham Lincoln, our president, actually was one of our policy holders. He paid $24 a year back in 1856. We also have Robert E. Lee's policy and Babe Ruth, okay? So that's our famous clients back in the day. Now, in 1929, the Great Depression happened. A lot of companies went under. We actually prospered during those times. And in 1932, Hartford was able to fund the Hoover Dam and the Golden Gate Bridge. So we are part of America. Now, this is in the past. Let me just take you to current events. In 2001, you know what happened. World Trade Center collapsed. Now, the worst terrorist attack in the U.S., we ended up paying $850 million in claims because we had a bunch of clients that actually pass away during those times. So we cover you on the terrorism or an act of war. The only exclusion on the Hartford is if you commit suicide. Okay? Just to give you an idea that we're not a new company. We have been in business for almost 200 years. And the stability of the company, now we get rated every single year. Just like in school, your kids get rated, we get rated as well. Now we're being rated by AM Best, which is a company has been doing this for 100 years now. We're an A+ rating company. That's our second best rating available actually. How do we achieve that A+ rating? It's because we keep $377 billion in assets to cover $307 billion in liabilities. That gives us an equity of $18.9 billion, which is in simple terms, Mr. Client, if all of our clients die, God forbid, we still have enough money to pay every single claim and continue to do business with. Now, that's really rare that all of our clients are going to die the same year. But if it comes to that point, we still have enough money to pay every single claim. Now, all this money is invested in government bonds. See, government bonds are guaranteed on principal and interest. So the bonds that we have are 15 to 30 years because most of the mortgages are 15 to 30 years. So the bonds guarantee the money guarantees the company. That's how we achieve the A+ rating. Okay? Now, any questions so far? No? Good. Now, let me just talk to you about benefit number 3 that we show you that we can actually get your money back. That's what we call cash value insurance. Now, cash value insurance is real simple. You get your money back. Now, cash value, you have two options, a variable policy and a fixed policy. Now, the variable policy has to do with the stock market. And I know you know how the stock market works. It can go up and down. And the problem with that is the risk, you inherit the risk. Meaning, let's say the cost of insurance is $100. And then 3 years from now, the market comes down. They can come back and say, you know what, Mr. Klein, we need $150 for the same policy. We don't do variable policies because we really don't want to come back and ask you for more money. The only thing that we do at the Hartford are fixed policies, which are guaranteed interest rate, which means the price that we quote you today, they're going to be here in the next 30 years. The price will never change on you. Why? Because we have the interest rate that guarantees from the bonds. So this is why we will always recommend you a fixed policy rather than a variable policy. Did I explain myself so far? Okay, good. Now, let me just talk to you a little bit about term. Have you ever heard about a term policy before? Now, term is like renting a house. Have you ever rented a house before? Okay, now the concept with rent is you pay every month, and at the end of the year, you can actually, your landlord is going to say, I'm going to increase your rent or you're out of the house. One of the two. The same thing with a term policy. They're going to give it to you for 5, 10, 15, or 20 years. Okay? Now, the problem with that is, let's say you're 39 right now. When you're 49, the price on that same term policy is not going to be that expensive, but once you turn 49, the price will increase. Okay? Now, from 49 to 59, they're going to give you another price, which is more expensive. And when you get to 59, again, the price will increase. So term policies, again, you don't control them. Every so often, you have to renew those policies. And there's no cash value, and you gotta medically qualify every so often. So that's why term policies, we will not recommend your term policy if you're younger than 70. If you were 70, Mr. Klein, I'll tell you get a term policy because chances of you dying are there. But you're only in your 30s, you need a policy that you can control it. Okay? Now, did I explain myself between term? Okay. Now, let me just go over the permanent policy, which you are the owner. You can keep this policy until age 100. You decide until when you want it. Okay? Now, the permanent policy is like you buy this house, you know exactly how much you're going to pay and until when. Exactly the same with a permanent policy. Now, the beauty of this is the price is level. It will not change at any time, and the cash value that you accumulated is yours. So let's say 20 years from now you never use the policy, you have this money available for you, and the price will always be the same. So that's why we always recommend your permanent policy, like you own the policy, rather to get a term policy that the insurance company owns that policy for you. Okay? Any questions? Good.